Good afternoon, everyone. This is Robert Rayburn here at Life Pro Asset Management. It is May 28th of 2024. I hope that everyone had an absolutely fantastic Memorial Day weekend. Special thanks, of course, to all the men and women, both here in the US and overseas, that serve our country. We could not be more thankful for your service. Now, as it relates to the market, last week, not the greatest week in the world, right? We saw markets pull back across the board, whether that was here in the US or overseas in Europe and in emerging markets and in China. And that shouldn't be too surprising. We had a pretty aggressive run. S&P 500 hit a record high. We saw huge moves over in China. So you know what? It's actually healthy that sometimes you get these pullbacks. And if you're within a positive trend and credit markets are healthy, there's a certain playbook to deploy, and we're going to go through that this week. But generally speaking, we use those moments to add to names that we like. And certainly if we see other areas that are rallying, we have exposure, but we've been trimming exposure, we use those moments to continue to reduce exposure. So that's really what we did last week. We certainly were not panicking. Performance year to date continues to be where we want it to be. And overall, we love where things stand right now. So with that said, let's go ahead and get started. I'm going to share my screen as I do every single week. And the title of this week's presentation is, buy the dip ? Right? And the reason for that is whenever you get these pullbacks in the market, there's always this concern of, is this the beginning of something greater and something deeper? Or should I be using this as a moment of discipline and adding to exposure? So three big things that we're going to focus on this week are, why are stocks pulling back in China and in the US? US stocks sold off on a good NVIDIA report. Why did that happen, right? You think about NVIDIA had an absolutely fantastic quarter. Everyone was waiting for this event, and then everything sold off after, with the exception of NVIDIA. So why did that happen? And lastly, we'll go through the difference of early and late cycle investing, especially if you're a global investor that have assets in the US and Europe and in Japan and China and emerging markets. It's good to know this stuff because whether something is early, whether a market is in early cycle or late cycle, changes how we allocate assets within the stock market. In terms of portfolio moves, there's three big things that we did. We continue to decrease our energy exposure across the board. Number two, we initiated some exposure within solar, and we're going to go through why we did that. And then lastly, we did maintain that bullish exposure across EM. We did add a little bit more to that. One move that's not on here, this is particular to the growth portfolios. We did reduce our cannabis exposure quite a bit. Real quick there, 90-day comment period on the Schedule 3. That's really going to render these stocks, in our opinion, dead money for the next couple of months. So, we have other areas that we think can go now. And so we want to not just have money sitting there doing nothing for the next 60 to 90 days. Let's try to make some money while these stocks rest. Now, in terms of the pullback, why did we see that market pullback? Well, quite frankly, we think the biggest reason is that everyone got short-term bullish, right? We saw aggressive moves in the S&P 500, overseas as well. S&P hit an all-time high. VIX, that volatility index, got below 12. And then China stocks ran really, really hard. I mean, we saw that with our own performance. And you know what? Sometimes they just needed to rest. You just need a moment to rest, catch your breath before you make that next move higher. And with China in particular, we think we're early cycle here, so we don't necessarily want to try and time these 3 to 4 day moves, but because the danger there is that you miss the big picture, you miss the bigger move. And so we want to make sure that we're positioned for the bigger move and what we think is going to be a multi-year rally. Lastly, of course, that NVIDIA report came out. It was great. But honestly, from a trading perspective, we think probably what happened there was that everyone was waiting for it. It happened. And then people made their portfolio moves. In other words, trimming back or pocketing some gains across the market. and they were just waiting for NVIDIA's report to come out to do that. So in other words, that NVIDIA report was sort of the catalyst to do whatever it was you were going to do with your portfolio, but you were just waiting for NVIDIA to report. So sometimes that happens, normal in the markets, classic sell the news type of event. So our thoughts overall here is that the US does appear to be entering a late cycle where we see slowing growth. Now, that should not be confused for recession, okay? Recession is one bucket over here. Slowing growth, soft landing type of scenario, that's actually kind of bullish. And, that's where we think the market is heading right now, is that US had some white hot growth in 2023, first part of 24. We think that 3 to 4% GDP growth number is slowing back into that 1 to 2% range. Number two, China EM stocks pulling back after a big rally. The trend is our friend. The trend has flipped positive for China and many emerging markets. So we want to use those pullbacks to add exposure to our favorite names. Third, credit markets remain well behaved. If there was a recession around the corner, if something more troublesome was brewing, it would be likely that you would see it pop up in the credit markets. Credit spreads would blow out. You would see bonds sell off across the board. You just haven't really seen that. So in our opinion, the primary risk right now is the divergence between late cycle markets and early cycle markets. If you're in the US, which is a late cycle market in our opinion, we want to allocate assets that do well in late cycle and shift away from what we call early cycle assets. If you're in a market like China, which we believe is in the early innings of a recovery, in other words, it's an early cycle market, we want to look at those sectors that do really well in the early cycle. So great way to diversify cross sectors when you can actually invest in different countries. And that's what we're doing right now here at LifePro. In terms of China, we saw over the last couple of months here, whether it's on the Shenzhen 300, positive trend flip. So in other words, the trend has flipped to being positive in that market for the first time in 3 years. We saw the same thing on the larger Hong Kong Hang Seng Index. Again, so if we are early cycle, what are the areas that we want to focus on? In particular, historically, you want to focus on technology, banks, consumer industrials, and industrial commodities. And that's where, if you look at our Chinese weights and our Chinese exposures, that's the area of the Chinese market that we've been most heavily focused on. And the other thing that keeps us bullish is that positioning remains quite bearish. So despite the big rally earlier this month and the month prior in April, the crowds have not yet woken up to the Chinese recovery story. In fact, the consensus still remains quite bearish on China. For us, that's a fantastic setup, especially since we participated in that first move upward. We continue to be positioned where we think is ahead of the crowd. In other words, skating to where the puck is going. At some point, we want the crowd to come over to where we're at to push those prices off. And then if things get overvalued, then we can unload those positions. But for now, we think the setup is pretty bullish because the fundamentals are getting better over in China. The valuations are very attractive, especially across their version of the Magnificent Seven. And no one's really invested there from a crowd standpoint. Copper backs up this thesis. We call it Dr. Copper for a reason. Copper tends to be an early cycle commodity. In other words, it tends to be correlated with rising or falling economic activity. China is the largest consumer of copper on the planet by miles. I think they make up close to 60% of global copper demand. And so when we see copper breaking out of multi-year bases, copper is breaking out of a 20-year base. As you can see here on the chart on the right, we believe copper is entering into a new secular bull market. Now, we're not necessarily playing that by buying copper directly. We're playing that by what that signals about China. And that's how we are making this copper play here over at LifePro. What does a late cycle look like? Well, quite frankly, what looks like late cycle are the US markets right now. So We look at the consumer discretionary sector, which tends to be a good early cycle sector. We can see here the relative performance of U.S. consumer discretionary stocks relative to the S&P 500 continues to fade. And we can see the same thing on the transports index, right? So that's that Dow theory, consumer and transports that really are the lifebloods of the economy. As those fade, it signals that, hey, you know what? We're probably getting a softening in growth. And it would not surprise us if we saw interest rates follow suit. One thing we did initiate positions in solar for the first time in 3 or 4 years. You're seeing a big move from the solar names. 2 sigma moves off the bottom. Now, there's a fundamental thesis here that all of this, the rise of AI in terms of the data centers and the power needed to maintain those, to keep those data centers operating. Well, that a lot of those companies are not necessarily going to plug into the grid, because the grid is really used for everyday companies and residential complexes. They're going to rely on building out their own power units through solar. So very interesting thesis there. The bottom line, though, is that solar is actually pretty cheap here. If you look at some of the leading names within the sector, the valuations are there. Suddenly you had this technical turn in the price action, and there is a potential tie-in there to AI where you haven't seen the crowds necessarily pile into yet. So we bought a couple of names in the space. We won't go into which specific names this week, but again, very interesting move off the bottom. So we want to participate a little bit. Lastly, credit markets remain well behaved, as we signaled here for many weeks now. Up is bad, down is good, right? So in other words, up means that companies are paying more to borrow money. Down means they're paying less to borrow money. So when these credit spreads come down, that's a good thing. You tend to get these blowouts when people are nervous about a recession or some sort of credit event in the banking system. We're just not seeing that right now. So overall, the stock pullback at this point appears healthy. We, of course, are going to monitor that, right? We're not making calls. We're just saying what the symptoms look like right now. Now, if those symptoms change, we'll change. We're not tied to a call. Number 2, China does appear to be entering an early cycle recovery, while the U.S. appears to be entering what we sort of call that late cycle maturation in terms of its growth rate and how stocks react within its market. And lastly, no signs of trouble from credit. So that's what we got for you this week, 888-543-3776. If you have any questions, please feel free to reach out to your advisor. And again, happy Memorial Day, and especially to all the men and women in uniform. Thank you for all that you do, and have a fantastic week.